Get started. Thank you so much, everyone, for taking the time out of your day to join our Independent Women webinar. The focus of today's session is around making sense of the autumn budget, potentially one of the most hotly anticipated autumn statements for a very, very long time. And hopefully you've all had the chance to read the kind of high level outputs from the budget. So my name is Lindsay Docherty. I'm one of the Independent Women Financial Advisors, and I'm based in our Edinburgh offices. Again, just a reminder for those of you that may not be clients, Independent Women is part of the Forvis Mazars brand, and we are the UK's longest running and only national independent financial advisor that specialises in wealth management for women. So really delighted to be able to speak with you today and to dive into some of the key points from the autumn statement last week. By way of housekeeping, today's session will run for around about 30 minutes and we'll have some time for Q&A at the end. Just as a reminder, today's session does aim to be as informative as possible, but given that the budget only happened last week, there are a number of aspects on which further detail is either required or there may be a consultation process to be followed. So we might not know the very specifics about certain points that have come out of the budget. If you do have any questions in regards to what we do cover today, or more specific questions in relation to your own circumstances, I would really encourage you all to either reach out to your Independent Women Financial Advisor if you're an existing client, or again, alternatively, if you're not a current client, I will provide you with the email address of our central mailbox at the end of today's webinar, and please do feel free to reach out to us. Okay, let's get stuck in. So I guess given that I'm one of the financial advisor and typically I advise on individuals' personal circumstances, my focus for today's session is going to be predominantly on the personal taxation changes. And I will at a high level cover off some of the corporate tax changes, but if you do have more specific questions about those, I can certainly direct you to the right people in order to answer any queries that I might not be able to. So let's get started, I guess, with the capital gains tax regime. As we said, you know, the autumn statement was probably one of the most hotly anticipated budgets for a very long time. And there was a huge amount of speculation as to what might change, particularly in relation to things regarding capital gains tax and inheritance tax. And interestingly, while we did see some changes to the capital gains tax regime, I think it is fair to say that we've perhaps not seen as significant an impact as what was perhaps reported prior to the budget. The main impact for individuals' capital gains tax is that the general rate of capital gains tax has been altered in order to align the rates to that of property disposal. So for basic rate taxpayers who dispose of assets, that tax rate is moving from 10% to 18%. And if you're a higher rate taxpayer or above, that rate is changing from 20% to 24%. What we were pleased to see is a retention of the capital gains tax allowance, which is effectively the amount of a gain that you can realise in any given tax year without incurring any capital gains tax charge. And that remains at £3,000 per person per tax year. Interestingly, on capital gains tax, which is slightly different to some of the other changes that were announced, is that these rates came into force immediately. So there was an immediate change, which meant that people couldn't then enact or capitalise on gains at the lower rates. Those changes came in as soon as they were announced. Ultimately, however, it's not highly likely that these change in rates will have a significant impact on people's decisions to transact on chargeable gains. We do still think that capital gains tax rates are much more favourable than, say, income tax, for example. The other significant change to capital gains tax has been for business asset disposal relief, or BADR for short, and I will refer to it as BADR from this point on. So BADR, for those that don't know, it's a type of tax that effectively reduces the amount of capital gains tax that's due after disposing of a business asset. And there are some really specific qualifying terms for something to be considered a business asset. BADR is available to provide a reduced rate of capital gains tax of 10% on disposal of gains up to £1 million. However, from April 2025, this rate will increase to 14%. And then from April 2026, that rate will increase again quite significantly to 26%. So in real terms, this means that if someone is looking to dispose of business assets, if they do it in this tax year, they could be up to £40,000 better off doing it in this tax year rather than disposing it after April 2025. So just something to consider if any of you might be impacted by business asset disposal relief. So what do these changes mean for individuals and what are the potential opportunities? There are types of investments that individuals can make that will enable them either to defer capital gains tax or perhaps even remove the liability altogether. These types of investments are called Enterprise Investment Schemes, EISs, or Seed Enterprise Investment Schemes, SEISs. Typically, what you'll find is these types of investments are much more volatile. So there are incentives such as capital gains tax deferral or removal. So it's really, really important that if you are likely to incur a significant capital gains tax charge and you would like to consider these types of investments, that you seek advice before entering into this type of arrangement. Okay. The other thing that's really important to remember, if you are considering disposing of an asset that will incur a capital gains tax charge, is that there has been no change to the spousal exemption rules. And the spousal exemption rules are there where spouses can transfer gains between each other before making a disposal without incurring any charges. The great thing about this spousal exemption is that it might enable you to utilise 2 capital gains tax allowances, you know, the £3,000 that you won't be charged tax on. But it can also be of significant benefit where perhaps one spouse is either a basic rate taxpayer or a non-taxpayer, and another is a higher rate taxpayer or above, really just spreading how much tax would ultimately be due. So just something to bear in mind if you think you might be impacted by the increase in rates. Okay. Another thing that we did see some significant reports on the lead up to the budget was how inheritance tax and how pensions might be changed. There were plenty of rumours. However, once again, while we saw some changes, broadly speaking, particularly in relation to inheritance tax, the impact on most people is likely to be fairly minimal compared to the current position. I guess the headline really is the current thresholds of inheritance tax, both for the nil rate band and the residential nil rate band, these remain frozen. The idea behind that is that the headline rate of income tax remains the same, there's no increase. However, it is really important to consider the impact of inflation here. So if we were to say house prices increase on average 4% per year, over a few years, you'll find that more and more people are likely to fall into the remit of paying inheritance tax, given that their estate is growing and the thresholds on which no inheritance tax is chargeable remain the same, they remain frozen. So this is what we consider those backdoor taxes, whereby the headline remains the same, it's staying at the same rate, but inflation is having an impact and ultimately more and more people are paying tax on their passing. Just as a reminder, the thresholds for inheritance tax are as follows. So you may be subject to inheritance tax on your estate if it exceeds £325,000 for an individual, or up to £500,000 for an individual if you're also leaving a residential property to a direct descendant. If you are married, if you have a spouse or a civil partner, you effectively double up on your allowances. So your nil rate bands collectively are £650,000 on second death, or up to £1 million on second death for married couples, and civil partners who are also leaving a residential property to direct descendants. So those figures remain the same, they're not changing. Anything in excess of this typically is charged at 40% inheritance tax. Some of the changes that we have seen in relation to inheritance tax are around agricultural relief and business relief, and those changes will take effect from the 6th of April 2026. So historically, there has been an unlimited 100% relief for both agricultural and business relievable assets. However, from April 2026, we will have a £1 million cap on combined agricultural and business property to attract that 100% relief, and anything in excess of that £1 million will have a relief of 50%. So quite a significant change. And while I'm not going to go into detail on this because I don't think it will impact the majority of people on the call, if you are in a position where you or someone you know will be impacted, it is well worth considering some accelerated succession planning. Really important to understand the business and the farmland valuations if you are impacted, and potentially considering things like trusts in order to start that succession planning at an earlier stage while you've got the time to do so. But again, well worth seeking advice on this if you're impacted by that. The main change, I suppose, that is relevant to the vast majority of individuals is regarding pensions. So after, again, weeks and months of the pension rumour mill being in overdrive, we had questions around whether contribution amounts would change, whether tax relief would change, lump sum allowances and treatment on death, if any of those elements would be altered in the autumn statement. The budget was quite surprisingly one-dimensional in the end from a pension perspective. What we've seen is that the major change is that from April 2027, pension funds will be treated as part of an individual's estate from inheritance tax purposes. So just to reflect a little on how significant that potentially could be, it's probably pertinent for us to quickly refresh on what the current treatment of pensions is on death. So as things stand now, and right the way through to April 2027, our understanding of pensions is that the vast majority are treated as sitting completely outside of the estate for the purposes of calculating inheritance tax on death. So pension funds almost never suffer that 40% inheritance tax charge, and typically can be passed to whoever the pension holder wants on their passing. Instead, pension funds are taxed under an income tax regime, depending on whether the pension holder died before the age of 75 or after the age of 75. So if the pension holder was to die before the age of 75, generally speaking, the beneficiaries of the pension funds suffer no income tax, either on receipt of funds or when they choose to access them. However, if death occurs after the age of 75, while the funds are past tax-free, they are subject to income tax at the beneficiary's marginal rate as and when they begin to access those funds. So no inheritance tax currently, but there is an income tax penalty if the pension holder dies after the age of 75. With the new proposals, and from our reading of the consultation process to date, it's suggesting that the income tax treatment will continue beyond 2027. But in addition to that, the pension funds will also be added to your estate for the purposes of calculating your inheritance tax bill. So potentially, and from our reading so far, we will suffer a double taxation, both inheritance tax and income tax for those that die after the age of 75. The final sting in the tail on this one as well is because pension funds will be added to the estate on death, there is a risk that your pension funds could potentially contribute to a loss of the residential nil rate bands. So just as a reminder of the current rules on this, if an estate exceeds the value of £2 million, for every £2 the estate exceeds 2 million, you lose £1 of your residential nil rate band. Okay, so given that pensions will likely come into calculations of estate, there is quite a significant potential impact for those that have overall asset base of in excess of £2 million. However, a couple of things to bear in mind when we look at the pension changes and what that might mean for you. The changes aren't proposed to come in until April 2027. So we have a bit of lead time in terms of planning for this and considering other options with regards to estate planning and utilising pensions by way of an income going forward. The other thing to note is that these changes are still very much in their consultation process. These are proposed changes. So there is quite a good chance that there might be some softening of that double or triple taxation hit that we've spoken about. So while it seems quite penal initially, really important to remember that we do have a bit of time to scale back depending on how that consultation process goes. Okay. The other thing that I'm going to just touch on, I'm not going to go into too much detail on this either, because again, for the vast majority, it probably won't impact you, but perhaps you do come in the remit of the non-domicile regime. The government did announce in the summer that it would look to alter the basis on which UK tax was charged on those that were not considered domiciled in the UK. At the budget, we received further details of these changes, and as we perhaps anticipated, the concept of domicile for tax purposes has now been replaced, or will now be replaced, by a residence-based system. So for taxation, domicile and residency are treated in two different ways, two different concepts. We're now replacing that domicile regime with a residency-based system. In summary, the new rules, and again, this is a very broad strokes summary, there's a lot more detail underpinning this. The new rules coming in force from the 6th of April 2025 include replacement of the remittance basis by way of a 4-year exemption for foreign income and gains. This will apply irrespective of whether the foreign income or gain is brought to the UK or not. There will also be overseas workday relief for those that are not domiciled in the UK and who work abroad during the tax year. That's going to be extended to 4 years, and it's also going to be simplified in the sense that you will no longer require a non-UK bank account in order to receive your salary. From an inheritance tax point of view, inheritance tax will apply to worldwide assets after someone has been a UK resident for more than 10 out of the last 20 tax years. And as a result, offshore trusts are also going to lose much of their excluded and protected status. So really important on this point, income and gains on protected trusts will become taxable on the settlor in many cases, and the trusts themselves will be subject to UK inheritance tax if the settlor has become a resident in the UK for 10 years. Okay, so there's potentially some quite significant impacts there if you do fall under this non-domicile regime or residence regime. And it's really important, again, to speak to your tax or financial advisor if you feel this is likely to impact you. The final point that I'm going to make regarding personal taxation and the changes is the changes that have been proposed or will be implemented in respect of VAT and stamp duty. So the headline for VAT is regarding the treatment of private school fees. From January 2025, VAT will start to be charged at a rate of 20% for private school and boarding school fees. We had seen a few precautionary measures taken by the private school sector, with many people prepaying school fees in order to avoid that VAT charge. However, we have seen an announcement of anti-forestalling measures that will apply. And basically, it's going to be put in place to ensure that VAT will still be charged on any prepayments that have been made in respect of terms that are starting on or after the 1st of January 2025. There is one exemption to the VAT rules, and that is where local authorities or devolved governments are funding children who have special education needs and where the state system cannot support them. The local authorities or governments will be able to be compensated for the additional VAT that they've paid in order to send that child into private school. We do expect that this will have a knock-on impact both on the numbers of students that are able to attend private schools, but also longer term, probably on the schools themselves in terms of affordability. So there will be kind of knock-on impacts of this over the longer term that we're likely to see. The other headline in regards to personal tax is the changes to stamp duty land tax. This has changed specifically for England and Northern Ireland. Really important to remember that Scotland have land and buildings transaction tax and Wales have land transaction tax, and there's no announcements made at this point in time for either of those regimes. So it's specifically relevant for those in England and Northern Ireland. From the 31st of October 2024, second home buyers, landlords, businesses who are purchasing a residential dwelling will see an increased rate in their stamp duty land tax from 3% to 5%. So quite a significant increase there. But there haven't been any changes to stamp duty rates for commercial property. Okay, so that is a kind of whistle-stop summary of some of the personal changes. And while I've said I'm not going to go into too much detail regarding taxation for employers, I think it is really important for us to touch on some of the changes that were announced because they are significant. And our expectation is, while they might not affect individuals in the immediate, actually longer term, if things become less and less affordable for employers, there will be a trickle-down effect that impacts individuals as well, employees. So let's touch on some of these changes in a little more detail. So the UK's national minimum wage and national living wage will be increasing from the 1st of April 2025. What does this mean? So employers are going to have higher employment costs, particularly as this is not going to just impact the salary that they're giving to their employees. It's also going to increase things like pensionable pay. So if an employer is contributing 3% of somebody's salary to a pension, obviously if their salary increases, the pension increases are going to be impacted as well. And by way of an example, to demonstrate the impact of this, if an employer has 100 people that are paid £11.44 per hour currently, they will see an annual increase of around £190,000 to their employment costs before we even factor in the changes to the employer national insurance contributions. So that could have a really significant impact on profit figures for employers, but also on their ability to retain the same levels of staffing. Naturally, as a result of these changes, employers are also going to need to revisit things like salary sacrifice eligibility thresholds. They're going to need to ensure that any employees that are participating in things like salary sacrifice pension, car schemes, cycle to work arrangements, make sure that they are still able to participate without falling below the relevant national minimum wage rate. So it's going to be quite a complex exercise, not just because of the changes to the salary requirements, but also any knock-on impact on other salary sacrifice benefits for employees as well. And naturally, as a result of this, employers will need to review reward strategy and structure to ensure that these remain affordable going forward. So that's where we potentially could see some knock-on or trickle-down impacts on employees themselves. The second headline here is, again, lots of rumours were floating around as to whether national insurance contributions would go up or potentially would they be added to, say, pension contributions instead. And the final decision announced was a general increase of employer national insurance contributions from April 2025. This increase is 1.2%, so the increase brings the national insurance contributions for employers up to 15%. And it also comes alongside a reduction to the threshold from which employers start to pay national insurance. So that threshold was £9,100. That's reducing to £5,000. So digging into the detail, there are some easements for employers to be aware of. While the government are reducing that threshold to £5,000 a year, the government will also be increasing the employment allowance and removing the eligibility threshold from the 6th of April 2025. This will mean that all employers will benefit, even those that are larger in size. So there's I guess, a slight softening of that potential blow for employers. Ultimately, however, this is going to increase cost pressures on businesses, especially when we couple that with national minimum wage increases. From a pure national insurance perspective, if we think of an employee who is paid £35,000 a year, from April 2025, the national insurance cost for the employer will increase by £926 per year for that one employee. So again, if we multiply that by the number of people that are going to be impacted, it is quite a significant cost burden on most employers. And as I say, ultimately, while it may not impact you negatively as an employee directly, it will require employers to consider their ongoing affordability. So potentially will have a longer term detrimental impact. I'm just going to briefly summarise some of the final announcements in relation to employers and the payrolling of benefits. I won't go into detail on this, however. The budget announcements just reaffirmed what we knew to be the case. You know, it reaffirmed the government's commitment to mandating the payrolling rather of all benefits other than beneficial loans and accommodation from the 2026-27 tax year. So again, really important for employers to assess their capacity to payroll benefits and to build in a project plan to start enacting this. So not a straightforward exercise for employers, and it's really recommended that businesses begin planning carefully for this. Okay. So kept very well to time here. That's I guess a whistle-stop tour of the budget. There are lots more changes, and again, lots more detail on those changes. I appreciate that given what's happened over the last week in terms of the autumn statement, but also the announcement today with the results of the US election, there's probably some questions as to what the market response looks like for those that are invested. And I just wanted to provide some detail that has been filtered down from our own investment management team. So in relation specifically to the UK budget, while we've seen a better indication provided by the OBR of inflation numbers, markets are not necessarily using that as a means of deciding movement and performance. What markets are looking at is taxes, and generally speaking, the overall response has been relatively positive. Reason being, the taxes are wide-reaching and they provide an extended fiscal space in order to generate investment into the economy. However, the predictions on what the investment into the economy will be are pretty significant, they're pretty high, circa £140 billion, and taxes are only supporting about a third of that investment. So it remains to be seen how realistic those expectations are, and markets will naturally react as things move forward. The other consideration from a UK perspective is that markets are pretty jittery. They like certainty. They don't like experiments. So what we're moving from in the UK, or what we're attempting to move from, is using debt as a means of market recovery to aiming to reduce that deficit and move away from debt. So that does leave a degree of uncertainty, and it does tell us that we're just going to need to watch this space a little in the UK to see how that might pan out and how the markets might respond longer term. Obviously, the other significant event, very pertinent given to today's timing, is the results of the US election, with the victory going to Donald Trump and the Republican Party. So as we know already from responses to the UK budget, markets love certainty, and global markets in the short term are likely to respond quite favourably to a clear-cut election result. What will have a knock-on impact, however, is over time, the US borrowing costs and the response to potentially higher inflation as a result of fiscal stimulus. So this may mean over the kind of next few months that the Federal Reserve cuts happen at a much slower rate than we were potentially anticipating. So that will have a knock-on impact on market performance. But the other element that will likely have a longer term impact on markets is who wins the House of Representatives. That remains to be seen, and I expect that might take a little bit longer than the election results have taken. If Republicans have control of the House of Representatives, it's a much easier path for them to enact policy. Whereas if the Democrats take control, they have a little more influence to slow and potentially stop Republican policy proposals. So again, we eagerly await these results because markets do respond very quickly to expectations around policy. So that's something that we'll be keeping a strong eye on. What I will say though is it's really important to remember that there are many drivers of global markets that go well beyond US elections and UK budgets. If we look at things holistically and if we take a step back and look at global markets, global consumption remains really robust. Inflation is falling across the board, and that is enabling interest rates to come down, and that in itself is stimulative for global economies. So it's really important to remember that, and really important not to equate the level of noise that we hear in the news with the impact on markets during investment timeframes. And as ever, when we are looking at investments and we are looking at markets, we are looking at those over a long time frame. So short-term movements should not result in knee-jerk reactions from any investors. Okay. The last thing that I'll say, obviously, today's discussion is for information purposes. Please don't take anything that I've talked about today as advice. But if you do have any questions or think you might be impacted by some of what we've discussed today, please do reach out to your financial advisor or reach out to Independent Women, and we can certainly support any discussion. Really important to remember that for many announcements, we are still going through a consultation process, and as ever, the devil is very much in the detail. And while I've not summarised every element of the budget, I've just tried to highlight some of the key changes and the potential knock-on impact that these might have. And if you do want to reach out, obviously, if you are an existing client, you will have a financial advisor with Independent Women. If you don't have an existing advisor, I put my details on the screen there. However, I am going on maternity leave next week, so I probably won't be best placed to support. But I have put the email address of our central mailbox there as well for you to reach out to, and we can certainly get you in touch with the right person. So with that, I'm going to stop sharing my screen and I'm going to see if we have any questions. And if you do have any questions, please do feel free to put them in the Q&A, and I'll give it a couple of minutes. We don't have any at the moment. And if not, I'll let everybody get back to their days. Okay. It appears that might be us, unless anyone's got anything urgent. Fantastic. Thank you so much, Carol. Really appreciate it. Great. Well, if anybody does have any questions that they want to follow up with on an individual basis, as I say, please do get in touch with us. We're more than happy to help. And other than that, take care, everybody, and have a good day. Thank you.